Welcome back to our Family First Advisors podcast. And I'm Omari Whyte. And today I want to share our investment philosophy. And, it sits at the heart of how we help our clients and their families to grow their family wealth towards their stated goals and well beyond. It's a philosophy that I describe as the pay to wait strategy, proven to make your money work as hard as it needs to achieve the required return. And these required returns they often exceed the returns that are needed to actually fund clients' stated goals. Most investors think of their return only when prices rise, that you need your security price to be higher than you bought it for to achieve a return. And that is, of course, capital gain type return unrealized. But really, thinking of how returns have been made over the ages and how successful investments have worked, using the S&P 500 as a proxy, and that's the 500 largest companies in the US, and using them as a proxy, a third of the return from the S&P 500 has come from the dividends of those companies. So somewhere between 30 and 35% of the return has absolutely nothing to do with the price that those investments achieved. And that's really underscores the power of the dividend component of the return. And dividends are a foundational component of equity returns, as I'm sure you'll agree. 30% of returns are explained by dividends. Really, this is a very effective way of helping investors to appreciate a return and realize a return during side markets or down markets. Really matters. Long-term charts really have less effect on clients' behavior than the short-term volatility and gyrations, especially when you combine them with life's imbalances. So the pay-to-wait strategy really means that you solely are not relying on just the price to go your way. You really generating a consistent return every night that allows you to compound that towards that required rate of return. So invested in dividend paying equities allows you to earn dividend income. Investing in interest bearing investment allows you to earn that interest income. And these two actual returns, because unlike when a price goes up, if you don't actually sell, that price retreating down takes away your gains. But dividends and interest are returns that you always keep. It doesn't matter if the price is up or down, which is the powerful part of dividends and the powerful part of interest. These regular payments allow you to really have more of your required rate of return building while your price action it takes weights for a more desired price. It gives you the comfort and the confidence of knowing that the return that you're going to require is at least a portion of it is already in hand. So very powerful concept for investors, really allowing them to stay disciplined. And we have found that that's one of the strongest factors that allows that the behavior, the best investment behavior in bad markets, right? But really at the core of our approach is asset allocation. Before we ever talk about specific investments or investment types, we need to align our clients' portfolios with their true risk tolerance. And so really how much of their investments are allocated to equity versus non-equity is the first and most important part of the portfolio construction, because that decision has a far greater impact on the overall performance of and outcomes of investments versus deciding, should we buy Royal Bank or TD? Deciding whether we should buy an equity versus a non-equity is a far more important choice. So it explains portfolio results and investment results far greater than trying to determine what security we should buy within the same security. So the idea of equity versus non-equity really gives us a portfolio construction that has a diversification of asset class. And this is a key component in managing overall risk and volatility. So non-equities or fixed income really have been Well, they're not glamorized. They're not like stocks that you get, you hear lots of sexy highlights about, or headlines, I should say, but they are a key component in an intelligent portfolio and for portfolio construction. Fixed income, they're thought of as low return type asset classes, but that is actually not entirely true at all. The wide range of fixed income actually is half of the global investable market. The equity market or the stock market is only a third of the entire global investable market. So fixed income investments have many, many different types, and they provide, but all of them are contracts, which allow them to provide a certain level of certainty that equities don't. You see, fixed income pays you regular interest every 6 months and is on the contract to give you your principal at the end of the term. And so that consistency of cash flow allows fixed income to act as help to reduce volatility in portfolios when combined in its right proportion to equities. It allows for that capital preservation when equities are drawdowns or the equity markets are volatile. It's not that equity market volatility doesn't create fixed income market volatility. It means that fixed income, based on having that contract nature of having regular payments and the contract of having your principal back, allows the return profile to complement an equity. So really acting as a counterweight or a balance with equity or within portfolios. So more importantly, fixed income really does provide the economic flexibility because having liquidity in a portfolio without having to sell your holdings and create capital gain or to create liquidity is a great component and a necessary component in many of our clients who we have retirement income plans for. We literally income needs to be income sources in their investments. And really that really creates a kind of clear demonstration of how their investment plan is actually working and they're getting returns that they're actually eating. We like to say that you're eating your returns. And so really that really supports a kind of healthy investment behavior that allows these great outcomes. And really, because Family First, investing isn't about predicting the next big market move. No, we construct portfolios that pay our clients to wait and really align their portfolios that risk change happens during the journey of an investor several times. And so discerning between whether those changes are spurious or momentary or temporal, or are they structural? Does your portfolio need to reflect the change in your risk tolerance that you currently report? That's an important question in any strong and any sustainable investment plan. So if you think that your investment philosophy or your portfolios have not reflected the kind of required return that you need to be able to fund your investment goals, that's the way investment philosophy is how we help our clients stay invested and they stay invested through market cycles, good and bad. Thanks for joining us, and we look forward to speaking with you next.